Gold just dropped 9%, and silver had a historic 27% one-day crash. Investors are freaking out because the Fed nominee's hawkish signals are shaking up global markets. This could affect your portfolio. Here's what's really going on behind the chaos. Okay, let's get right into the chaos that is affecting markets around the world today. Monday was just like any other day until the news broke. Kevin Warsh has been chosen to be the next chair of the Federal Reserve. And almost right away, the markets reacted with a shock that traders haven't seen in decades. A storm of selling hit precious metals, energy, and industrial commodities, leaving investors scrambling to find a safe place to hide. Let's look at the numbers first, since they tell the story much better than words alone. Gold, which is one of the safest places to put your money, fell an incredible 9%, reaching its lowest point in more than 2 weeks. Silver also fell more than 13% in the same session. That level of volatility is very high. Silver's moves are some of the most extreme in modern trading history, and they are on par with the big swings we haven't seen since the early 1980s. And it's not just metals that are valuable. The same thing happened with industrial goods. Oil prices fell by almost 5.5%, coming down from multi-month highs. Copper prices fell by almost 5% on the London Metal Exchange. The sell-off wasn't just in one place. It affected almost all major commodities. The size of the move showed that investors were very worried and that they were rethinking risk in general. So, what made Warsh's nomination cause such a strong reaction? The markets see him as hawkish, which means he is likely to want higher interest rates for a longer time. When the Fed takes this kind of stand, it has a direct effect on commodities, especially gold and silver. When rates go up, holding metals and other non-yielding assets becomes less appealing because the opportunity cost goes up. And sure enough, the US dollar got a lot stronger, which put even more pressure on metals and commodities around the world. CME Group raised margin requirements on metal futures, which is another technical factor that is making things worse. When margins go up, traders have to put more money down to keep their positions. That higher capital requirement makes it hard for leveraged traders to hold on to their positions for long, which is what happened on Monday. Some analysts are calling this a perfect storm for metals because of the combination of a hawkish Fed signal, a stronger dollar, and higher margin requirements. Let's look back in time to put this in context. It hasn't dropped this much in one day since 1983. That was over 40 years ago. And the way people are selling off their stocks and taking on more debt is eerily similar to what happened during the global financial crisis in 2008. Traders use terms like stop-loss cascades and panic liquidations when the market is really bad, and that's exactly what happened here. Even experienced professionals were surprised by how big and fast the moves were. The effect wasn't just felt in the US. Asian stock futures fell into the red, just like metals did. It was clear that investors were nervous as they tried to figure out if this was just a temporary liquidity event or the start of something bigger. Some traders were selling just because they were scared, which made prices go up even more. This is a classic case of risk-off behavior, where panic in one type of asset spreads to others, causing a domino effect. Energy markets, on the other hand, told a slightly different story. At first, oil prices were under pressure, but they started to ease up. Reports said that the US and Iran were getting along better. President Trump's comments over the weekend made it sound like Iran was seriously talking to Washington, which eased worries about a quick conflict in the area. The Iranian Revolutionary Guards also said there would be no live-fire exercises in the Strait of Hormuz, which gave oil markets a break. So, even though metals were falling off a cliff, oil's drop was partly cushioned by these geopolitical factors. China, on the other hand, is the world's biggest buyer of industrial metals. Before the Lunar New Year, which starts on February 15th, demand for copper, iron ore, and other important materials was expected to be low. Traders there were careful because their stocks were already high and they thought end-user transactions would be slow. This meant that the drop in industrial metals prices was caused not only by expectations about US monetary policy, but also by seasonal and structural factors in global demand. So, to sum up where we are right now, the markets are responding to a very hawkish Fed signal, which is made worse by a strong US dollar, higher margin requirements, and traders who are using leverage leaving their positions. Gold is down 9% and silver is down 13%, which is the worst of the precious metals. Asian markets are deep in red, and industrial goods like oil and copper have also lost a lot of value. Energy markets are starting to stabilize a little bit because geopolitical tensions are easing. However, global demand for commodities is still low, especially in China before the Lunar New Year. This is a classic case of many things coming together at once: monetary policy, leverage, geopolitical news, and seasonal demand patterns. And as traders and investors take in this news, the market is likely to stay volatile, at least for a little while. This is a very important time for anyone who owns metals, industrial goods, or stocks related to them. Before making any decisions, you need to know what caused this crash, not just the numbers, but also how the selling worked. At this point, the most important thing to remember is that this isn't just a small correction. It's a sharp, complex reaction in the market. But it's also important to see the small differences: geopolitical easing in energy markets, seasonal demand patterns in China, and historical context all affect what might happen next. With gold, silver, oil, and copper all falling quickly, and investors all over the world changing their positions, the question now is, how will the market settle down? What are the next events that will cause changes, and which traders are most at risk? We'll talk about all of that in the next part, where we'll go into more detail about metals, commodities, and the technical changes that are happening. Now that we've talked about the first shockwaves in global markets, let's focus on precious metals and important commodities, because that's where the action was the most intense. And just to be clear, we're not making this up when we say it. The changes in gold and silver prices during the day were historic, the kind of moves that make traders' hearts race. For example, silver. It fell 27% in just one day last Friday, which was the biggest drop in one day ever. Gold wasn't far behind, though. It had the biggest drop in spot gold prices since 1983. To put it in perspective, these kinds of moves don't happen every day on the market. They happen once every few generations. This kind of volatility not only scares traders, but it also scares institutional investors who thought they had protected themselves from risk. So, what made these swings so big? A lot of it has to do with leveraged positions. When prices started to drop, traders who had borrowed money to buy more gold and silver had to quickly sell their positions. That sale set off stop-loss cascades, which are automated orders that are carried out when prices go below certain levels. This made the crash even worse. In a sense, the market became a feedback loop of selling, with each layer pushing prices down faster and faster. UBS analysts have said that silver had already gone up 250% year-on-year before this correction. That kind of meteoric rise made the market ready for a big drop. When assets rise that quickly, it's not uncommon for markets to suddenly change their prices, especially when something new happens, like Warsh's nomination. UBS stressed that markets were already very unstable before Friday's drop, with daily swings in the high single digits to mid-teens and even wider ranges during the day. On top of that, the CME Group raised the margins on metal futures. It's not just a technical note when margin requirements go up, it's a direct liquidity squeeze. Traders need to put more money into their positions, and if they can't, they have to leave. That has a double whammy effect. Speculators leave the market, making it less liquid, and prices go down even more. To put it another way, the increase in the margin was like throwing gas on a fire that was already burning. It's not just numbers and rules that affect markets. The way traders think is a big part of it. There was a lot of panic selling going on. The FX markets were also very unstable, with the US dollar going up and down a lot and other currencies doing the same. The combination of leveraged positions, automated stop losses, and selling based on fear made metals and commodities prices rise much faster than they could have on their own. Oil also fell a lot, about 5.5%, as it switched to energy. But the story is a little different there. Oil's drop was mostly caused by geopolitical easing, while metals' move was driven by margin and speculation. Reports over the weekend said that the US and Iran were talking seriously, which eased fears of war. Iran's Revolutionary Guard said they had no plans to hold live fire drills in the Strait of Hormuz, which is one of the most important shipping lanes in the world. That's big news for the oil markets. At first, worries about supply made prices go up, but the de-escalation helped slow the drop, even though traders were still cautious in the unstable market. Now, let's talk about metals used in industry, like iron ore and copper. Both had problems because of high inventories and low demand, especially before China's Lunar New Year, which starts on February 15th. China is the world's biggest consumer of industrial metals, so seasonal slowdowns are normal. But when they happen at the same time as global market panic, they make things worse. Traders saw that warehouses were full of goods and that end-user demand was low, which pushed prices down even before the US was taken into account. News from the Fed. Other goods weren't safe either. Tokyo rubber dropped by almost 3%, and Chicago wheat and soybeans dropped by about 1%. These numbers may seem small compared to the metal carnage, but they tell a bigger story. The risk-off mood had spread to all commodities. Investors stopped separating asset classes. Everything was being looked at, and selling pressure in one market spread to others. At this point, it's important to tell the difference between short-term panic and long-term trends. Many experts, including those at the Commonwealth Bank of Australia and UBS, said that what we're seeing is probably a correction and not a long-term downturn. A correction is when the market realigns after a big rise, while a structural downturn means that demand or supply has changed in a big way. Years of bullish momentum, leveraged positioning, and speculative fervor had pushed gold and silver up. The recent crash was bad, but it doesn't mean that precious metals won't be valuable in the long term. It's more about positioning and liquidity in the short term. So, what does this mean for people who trade and invest? For one thing, the volatility is still very high. There are chances to make money when people panic sell, but there is also a lot of risk. Anyone thinking about getting into metals or commodities now needs to know how both the technical and psychological parts work. Leveraged traders, automated orders, margin requirements, and FX swings all work together to make moves bigger in ways that aren't always clear. Finally, the drop in metals and commodities prices is already affecting other financial markets. Stocks, especially those connected to metals and mining, have been under a lot of pressure. Asian stocks opened sharply lower, just like commodities did. Risk appetite has gone down, and even sectors that aren't related are seeing volatility as investors rethink their exposure across the board. To put it another way, what began as a metals crash is now turning into global financial worry that is affecting everything from currency markets to industrial stocks. In short, the last few days have been a shocking reminder of how connected the world's markets are. The metals crash shows how easily people's feelings can change when things are uncertain. It started with silver's historic 27% drop, then margin-driven selling, panic psychology, and FX swings. And even though tensions between the US and Iran have eased, industrial metals and other commodities are still facing structural and seasonal headwinds. The next big question is how these events will affect stock markets, bond yields, and the confidence of investors around the world. Will things settle down as traders adjust their positions, or will panic spread even more in the financial markets? That's what we'll talk about next as we look at stocks, the spread of the market, and the bigger effects of this commodity sell-off. After a week of heavy selling that shook up the commodities markets, today saw a partial recovery, which traders and investors really needed. Gold is still down, but only by 1.6%, and it's now trading at about $4,590 per ounce. Silver is down 1.4% and is now trading near $83 per ounce. These numbers show that the market is starting to calm down after the panic caused by Kevin Warsh's nomination to the Fed, even though volatility is still high. Equities are a clear sign of recovery. The FTSE 100 reached all-time highs today as metal prices stabilized and mining companies made up some of their earlier losses. Shares of major gold mining companies like Newmont and Barrick Gold rose 3 to 5% during the session, showing how quickly feelings can change once the initial shock wears off. It makes it very clear that metals and stocks are very closely linked, especially in areas that are directly affected by commodity prices. What is causing this stability? To begin with, the mood in the market is getting better. Traders who were scared at first because of Warsh's hawkish stance are starting to feel better. Last week's moves were extreme, but today's calmer trading shows that many investors are putting fundamentals ahead of fear, adjusting their positions, and even taking advantage of low prices in metals. That leads us to the possible policies of Kevin Warsh. People in the market are closely watching how he handles quantitative easing, interest rates, and the Fed's openness. People think Warsh is hawkish because he says he's ready to keep interest rates higher for longer, but there's more to it than that. Analysts are talking about situations in which he might slow down QE, or even think about lowering interest rates if the economy is under a lot of stress, especially if market turmoil threatens the stability of the whole financial system. His push for more openness is also expected to make it easier for markets to talk to each other, which could cut down on the kind of surprise-driven volatility we saw this week. Currency markets also show how this feeling is changing. The US dollar rose sharply at first because people thought that monetary policy would become stricter. But the dollar's gains slowed down as metals recovered and volatility went down. Forex traders now see a mixed picture. The dollar is still strong against most major currencies, but the sharp swings have stopped, which has let metals recover some of their losses without putting immediate pressure on the FX market. In the meantime, the fallout in the Chinese market was bad. Traders are said to have lost about 1 billion yuan because of the panic in the metals market. Some people left the market completely to avoid losing more money. This showed how much leveraged risk can make losses worse in unstable markets. But as sentiment stabilized, the Chinese industrial metals market also started to recover, which means that the fundamentals are still in place and long-term demand may come back once the seasonal slowdowns are over. Analysts are already talking about the long-term outlook for metals. For instance, UBS thinks that silver will settle around $85 per ounce, while gold could reach $6,000 per ounce by the end of 2026, assuming current monetary policies and geopolitical conditions stay the same. These projections show that precious metals are still a good investment for strategic investors, even though there is a lot of short-term uncertainty. This is especially true for those who can handle risk and take advantage of price swings. Speaking of chances, the way the market is right now makes it easier to buy selectively and manage risk. Investors can buy at lower prices when the market is very volatile, but they need to be careful. People who don't know how to manage risk are still at risk from leveraged exposure, which caused last week's panic. Investors can make a lot of money over the medium to long term by strategically spreading their money across metals and being patient and aware of macroeconomic factors. From a broader macro perspective, commodities markets are still affected by a complicated mix of Fed-driven monetary policy, geopolitical events, and seasonal trends, especially in industrial metals. Gold and silver seem to be on the verge of a slow recovery, but oil, copper, and iron ore will continue to have problems because of high inventory levels and changing demand, especially in Asia. But today's partial rebound shows that the market can stabilize, and traders who stay disciplined are likely to make money. In conclusion, the metals and commodities market is not new to volatility. This week's flash crash showed how leveraged positions, automated trading, and uncertainty about world events can cause big short-term changes. But the partial recovery shows that the markets are adjusting, and the long-term fundamentals, especially for precious metals, are still strong. Investors and traders should pay close attention to global economic signals, central bank decisions, and seasonal demand factors. They should weigh short-term opportunities against possible risks. The most important thing to think about in the next few days is what we should keep an eye on to predict the next moves in metals, commodities, and stocks. Analysts say to keep an eye on what the Fed says, important economic data releases, China's reports on industrial metals inventories, and changes in the geopolitical situation, especially in energy markets. These things will probably decide if this stabilization leads to a long-term recovery or if the markets have more trouble. As the dust settles on last week's historic events, one thing is clear. Volatility is not the enemy. It's a chance. If you pay attention, position yourself wisely, and stick to your rules, now is a rare chance to strategically engage with the markets, capture value, and get ready for what could be a strong metals rally in the months to come. Markets are unstable, metals are rising, but the effects of Fed policy, geopolitical tension, and seasonal demand are far from over. Stay informed, keep an eye on your positions, and don't let fear guide your choices. If you found this breakdown helpful, please like, subscribe, and turn on notifications so you never miss the next market update. Your portfolio will thank you.